Most people think investing should be exciting, a roller coaster of highs and lows. But what if I told you that one of the world's most successful investors, Warren Buffett, believes that excitement is one of the fastest ways to lose money? It sounds completely backward, right? We're often taught to look for the next big thing, the explosive stock that's going to make us rich overnight. But Buffett's philosophy, the one that built his multi-billion-dollar fortune, is the exact opposite. He avoids the thrill. He actively runs away from the very thing that draws most people in. If you're new to investing, or even if you've been at it for a while, this might come as a surprise. Some of the wealthiest people on the planet don't chase trends, they don't buy into the hype, and they certainly don't get caught up in the latest hot stock tip from a friend. They do the complete opposite. And today, I'm going to break down exactly why this boring approach works, why excitement can be your portfolio's worst enemy, and how you can apply these same principles to your own financial journey. No matter how much you have to start with, this isn't just theory. It's a practical guide to shifting your mindset from a gambler to a true investor. Let's get into it. So, what exactly is the problem with excitement? Think about it. When an investment is described as exciting, what does that usually mean? It means high volatility, explosive potential, and the promise of fast, life-changing returns. It's the story of a small tech startup that could become the next Google, or a new cryptocurrency that's going to the moon. This excitement generates a powerful emotional response. You get a rush of adrenaline, a fear of missing out, or FOMO. And you start imagining all the things you could do with the money you're about to make. When these emotions take over, your rational brain takes a back seat. You're no longer making a calculated decision based on fundamentals and long-term value. Instead, you're making an emotional decision driven by greed or fear. And emotional decisions are almost always terrible financial decisions. Excitement makes you impulsive. You might buy a stock at its peak right when the hype is at its loudest, only to watch it crash moments later. Or, when the price dips slightly, the same excitement that made you by now turns into panic, and you sell at a loss, terrified of losing everything. This emotional roller coaster is a recipe for disaster. It encourages you to buy high and sell low, the exact opposite of what you should be doing. The market is designed to transfer money from the impatient to the patient, and nothing makes you more impatient than the intoxicating lure of quick, exciting gains. It's like a casino. The house always wins because it preys on the hope and excitement of the players, not their logic. Warren Buffett understood this early on. He knew that to win the game, he couldn't play it like everyone else. He had to remove emotion from the equation entirely. This leads us directly to Buffett's core philosophy. If he's not looking for excitement, what is he looking for? The answer is almost comically simple. He looks for boring businesses. Yes, you heard that right. Boring. He searches for companies that are easy to understand, businesses with a long history of predictable, stable earnings. Think about companies that sell products people need and use every single day, year after year, regardless of what the economy is doing. Companies that sell soda, chewing gum, insurance, or ketchup. These businesses aren't going to be on the front page of financial news heralding a 1,000% gain overnight. They don't have dramatic stories or revolutionary technology that promises to change the world in the next 6 months. There's no hype, there's no drama, there's just consistency. Buffett calls this his circle of competence. He only invests in industries he thoroughly understands. If he can't explain what a company does and how it makes money in a few simple sentences, he won't invest a single dollar. This is because complex, exciting businesses often have hidden risks that are difficult to see. At a company that makes chocolate bars? You know exactly how it works. This focus on simplicity and predictability is the bedrock of his strategy. He's not trying to predict the future. He's trying to find businesses so durable and so simple that you don't need to predict the future. Their success is almost inevitable over the long term. It's a powerful mindset shift. Instead of asking, what's the next hot trend? Buffett asks, what will people still be doing in 10, 20, or 50 years? The answers are usually pretty boring, and that's exactly where he finds his greatest opportunities. So why does this boring strategy work so incredibly well? It comes down to one of the most powerful forces in finance: compound interest. Einstein supposedly called it the eighth wonder of the world. Compounding is the process where your investment returns start generating their own returns. It's like a snowball rolling downhill. It starts small, but with enough time, it grows into an unstoppable force. However, there's a crucial catch. For compounding to work its magic, you have to stay invested. You need to give it time, years, even decades, to do the heavy lifting. And this is where boring investments truly shine. When you're invested in stable, predictable companies, you're not constantly worried about the daily price swings. You're not glued to your screen panicking every time the market has a bad day, because you understand the business and you trust its long-term value. You have the confidence to hold on through market downturns. In fact, you might even see those downturns as opportunities to buy more at a discount. Staying invested is so much easier when you're not on an emotional roller coaster. Boring investments remove the temptation to constantly tinker with your portfolio, to chase the next shiny object, or to sell in a panic. They allow you to be patient. And patience is the fuel that compounding needs to create true generational wealth. The excitement of fast gains often leads to fast losses, interrupting the compounding process before it ever gets a chance to get going. Boring, on the other hand, is the slow, steady, proven path to letting your money work for you day in and day out for years to come. Now, you might be thinking, this is great for a billionaire like Warren Buffett. But how can I, a beginner, actually apply this? The good news is you don't need millions of dollars to start thinking and investing like Buffett. The principles are universal. First, focus on simplicity. You don't invest in anything you don't understand. If a friend tells you about a guaranteed hot stock in a complex industry like biotech or quantum computing, and you can't explain it yourself, just walk away. Your best bet is to start with what you know, or with broad, diversified investments like low-cost index funds that track the entire market, which is a strategy Buffett himself recommends for most people. Second, avoid trends and hype at all costs. When you see a stock or a cryptocurrency being talked about everywhere on social media, on the news, by your coworkers, that's usually a sign that the excitement has already peaked and the risk is at its highest. Remember, by the time you hear about it, the big money has likely already been made. Be a contrarian. Be skeptical when everyone else is greedy. Third, invest consistently. Instead of trying to time the market by throwing a lump sum in at the perfect moment, which is impossible, commit to investing a set amount of money regularly, every month or every paycheck. This is called dollar cost averaging. It forces you to buy more when prices are low and less when prices are high, smoothing out your returns over time. And finally, the most important part, give your money time, a lot of time. Think in terms of decades, not months. Plant the tree today, but don't expect to sit in its shade tomorrow. Patience is your single greatest advantage as an investor. To wrap it all up, the biggest lesson we can learn from Warren Buffett isn't some secret formula or complex trading algorithm. It's a fundamental shift in mindset. True wealth isn't built in a flurry of excitement and risky bets. It's built slowly, methodically, and often quite boringly. It's built through discipline, patience, and the incredible power of compounding. By choosing to invest in simple, understandable businesses and holding them for the long term, you take emotion out of the equation and let time do the work for you. So the next time you feel the pull of an exciting investment, take a step back and ask yourself, what would Buffett do? Chances are, he'd be looking for a quiet, boring corner of the market, letting patience build his fortune while everyone else is chasing the thrill. If you found this video helpful and want more practical investing insights, make sure to hit that subscribe button and turn on notifications so you don't miss the next one. Thanks for watching.